Okay, just check. Okay, my name is Vipin. I'm a assistant professor at the Indian Institute of Technology, Madras. Please allow me to welcome you to this session on fiscal and monetary policy responses to COVID-19. I'm delighted to welcome Professor George Selgin of the Cato Institute and Director of the Center for Monetary and Fiscal Alternatives, and Professor Christopher Coyne of the Department of Economics at George Mason University. To this session. George and Chris have both done a fair bit of work over the years on monetary and fiscal issues. George is one of the founders of the modern free banking school, if you'd like to call it that. George's the most recent book is titled The Menace of Fiscal Quantitative Easing, published by the Cato Institute. A book which is becoming increasingly relevant in the world that we live in. Chris is, as I said, a professor at the Department of Economics at George Mason University. Chris's work, particularly in the last few years, has focused on the consequences of government intervention, both at home and abroad. His most recent book is titled Perfecting Tyranny, Foreign Intervention and the Loss of Liberty at Home. And so we would, let me stop there with the introductions because I'd like to give maximize the time that's available for Chris and George to speak. Please allow me to welcome George to speak on the monetary aspect of government intervention in the wake of COVID, after which I'll welcome Chris to speak. Thank you, George, and the floor is yours.
Thank you, Vipin. Well, as I'm sure you, all of our listeners know, the Federal Reserve has been extremely busy since the crisis broke out, roughly since March 17th, or a little bit more than, a little bit less rather than a month ago. It has been engaged in all kinds of special programs aimed at trying to bolster the economy despite the lockdown, which is of course doing tremendous damage. I'll talk very briefly about the Fed's monetary policy efforts, but I mostly want to move on and talk about its emergency lending because that's where things get a little bit more complicated, as well as a lot more controversial. With regard to monetary policy, there have been two main developments. First, interest rates, or the interest rate target range that the Fed sets, has been lowered back to near zero, which is where it was during the 2008 crisis and for some time afterwards. So there is a target rate range of between 0 and 25 basis points for the federal funds rate. And the interest rate on excess reserves, which is the main administrative rate the Fed uses to implement its target, is actually lower than it's ever been since the 2008 crisis. It is just 10 basis points. Of course, before 2008 or before the crisis, then it was at zero, but it's been at least 25 basis points since until recently. So that's about as low as the Fed is prepared to go. On the other hand, of course, it can resort and has resorted again to quantitative easing as a way to lower long-term interest rates. And there, the basic story is that from a balance sheet of about 4 trillion, or actually a little bit less for a while, it has gone to already to $6.5 trillion. And it's expected to go all the way to $8 trillion. So 4 trillion was 4 times the pre-2008 crisis level. 8 trillion obviously is going to be 8 times that level. So this is a phenomenal development in the Fed's balance sheet policy. Well, I'll say no more about those programs, although, of course, they're controversial enough. I want to talk mainly in the time left about the Fed's special emergency lending or market for support facilities. And here, the Fed has launched something like 10 special facilities since March 17th. Several of them are already operating. Some have as yet not come online. And what I'm going to do is go from the least to the most novel and controversial. That is, I'm going to take us along, as it were, the same slippery slope down which the Fed itself has traveled, where the further we go into the programs, the riskier and more politically charged they become. So the first batch of programs, if I can get my computer to show them to me, hold on just a second. I do have notes here because it's too hard to remember them all. The first programs all resemble programs that were launched in 2008 or around that time, with some different details, and some of them are really quite similar, and they're the least controversial of the programs that have been launched this time around. So I'll go through those relatively quickly. The first is the primary dealer credit facility. I'll spare you the acronyms. You can figure them out yourself. This is a facility that is relaunching from the past, so it's not anything new. And it involves the Fed in making mostly overnight loans to primary dealers. These are broker dealers that with which the Fed has long engaged, but they, as broker dealers, they are not banks. So now most of them, all of them are subsidiaries of bank holding companies. Essentially, these loans resemble the more routine discount window loans that the Fed makes to ordinary banks. And they are, among other things, fully secured by collateral, and that makes them the least controversial of the emergency lending programs that the Fed is involved in, because, as we'll see, many of those are not fully secured. In fact, most of them are not fully secured. Some aren't secured at all, and that means that there's some prospect for losses to be made. So the second program is the money market fund liquidity facility. This very much resembles, though it's not identical to, a 2008 era facility that was called the asset-backed commercial paper money market mutual fund facility. At very least, the new one improves on the old one by having a shorter name. On the other hand, it has a longer list of collateral that's accepted. And I think it's fair to say that in general, where these programs that resemble 2008 programs differ from the originals, it tends to be by involving a more generous terms, a more generous collateral. Because this facility is unsecured, this is, by the way, this is basically the Fed making loans to banks and also to broker dealers for the purpose of them buying the assets of prime money funds. And those assets are not on the ordinary list of discount window collaterals. So that's why a special program is needed even for banks that buy those assets. It's unsecured, and for that reason, it's one of several facilities that involves a Treasury backstop. That is a Treasury contribution, essentially of capital, in this case, $10 billion, which is there to absorb any losses that may result from this program. Next, we have the commercial paper funding facility. That's another, all these facilities are operated through so-called special purpose vehicles, where the Fed lends to the vehicles and then the vehicles do their thing. And this one supports investments in investment grade commercial paper. It's also unsecured. It's been operating since Tuesday. The Treasury backstop for it is another 10 billion, but so far it hasn't been very popular. It's only about less than $1 billion has been lent through this facility as of late last week. The last of the less controversial facilities is the term asset-backed securities loan facility. This is a revival of the same named facility of 2008, the TALF, you'll probably remember. This one's not operational yet. It makes 3-year loans to private investors, also through a special purpose vehicle, to purchase newly issued, high-rated asset-backed securities. It's unsecured, therefore it has a backup from the Treasury also. Another 10 billion, this one's supposed to be able to lend up to 100 billion. Okay, those are the least controversial facilities. Now we come to the more controversial ones. And the first of those is the primary market corporate credit facility that has the Fed purchasing through a special purpose vehicle, newly issued investment grade corporate debt directly from the issuers, which is somewhat controversial. Then a very closely related facility, the secondary market corporate credit facility, secondary market that is purchasing the same kinds of investment grade corporate debt on the secondary market. Both of these are unsecured and risky, so the Treasury has provided a backstop for both of them of 75 billion, and their combined lending authority is 750 billion. And this ratio, by the way, of 10 to 1 is more or less the ratio that the risky programs, that applies to most of the risky programs with some minor variations. So the Fed and Treasury speak of levering up the Treasury's contribution 10 to 1. That's one way to look at it. The other is, and I think more useful way to look at it is, they're expecting that on average, if the Fed lends as much as possible under these programs, it might lose 10%. It cannot lose more than that. And so it's going to have to play it on the cautious side of that 10% line. Finally, not quite finally, but the Municipal Liquidity Facility, another special purpose vehicle. This one purchases municipal securities from states, towns, and also counties. It's got a 35 billion backstop with a 500 billion Treasury limit. So there you see a somewhat more modest assumption of the possible riskiness of that program compared to the others we've mentioned. And now I'm going to get to the most controversial. This is the Main Street lending facility. It's actually two programs. One allows for new loans financed by the Fed through banks to medium-sized businesses, 500 to 10,000 employees. And it's done through commercial bank lending partners. It's meant to complement the Small Business Administration's $350 billion Paycheck Protection Program. But it deals again with larger businesses. The SBA's program is aimed at firms with 500 employees or less. This one has a $75 billion Treasury backstop, and it's authorized to lend up to $600 billion. Finally, related to this, the Fed has announced that it's backstopping some of the SBA's loans, which means it's prepared to take some of those loans off the balance sheets of banks that are making them, so as to make it easier for those banks to make them in the first place and to make new ones when it's sold the first round to the Fed. I should say, I think I skipped something on the Main Street lending facility. That facility can either make fresh loans to medium-sized businesses, or there's an extended loan facility that can extend outstanding loans. All of those loans of the Main Street facility are to be used only for certain kinds of expenses that borrowers might have to meet, and they're conditional on the borrowers using some of the funds to maintain employment, to keep their workers working. Okay, so that's the summary, and it's used up about a little less than half of my time. I hope it wasn't too overwhelmingly fast, but I did want to be able to make some critical observations about these programs. I'll start with some more positive observations, and then I'll move on to what I think are the problems. I should first of all begin by noting that this is not a crisis that the Fed can in any way be said to have caused. Yes, there are people who argue that what we're seeing here is just the pricking of an over-investment or malinvestment bubble, where the coronavirus has done nothing but provide the straw that is breaking the camel's back, so to speak. I don't attach too much credence to that view. I don't think that that the market before this crisis was one great big bubble. It's true that interest rates were very low leading to the crisis, but that's not because the Fed has artificially held them down. It's because of largely demographic developments beyond the Fed's control. The Fed has been following rates down lately more than pushing them down. Now, there is an element of truth to the Fed's to blame hypothesis, in that as a result of its last round of emergency support programs, it did create some moral hazard, and it's doing more of that presumably now, whereby firms were more inclined to go out on a limb and buy risky, engage in risky investments, accumulate risky loans, leverage themselves excessively. And part of that is due to low interest rates that I said was not the Fed's fault, but it's also a response to the perception that the Fed's safety net has now been much broadened since 2008. So we did find that there was a lot of indebtedness and relatively little holding of cash for a rainy day. A lot of risky investment taking the place of safer cash investments. And that, of course, has made the collapse as a result of the lockdowns all the more dramatic. And the need for Fed support has been consequently correspondingly dramatic. Okay, having said that as background, I think the Fed deserves some credit, for the relatively rapid response this time around to the crisis, which was much less hesitating than in 2007, 2008. Of course, that's to a large extent because it was able to dust off some of those old facilities, and it was less hesitant to use them a second time around because it had, after all, the precedent of 2007 and 8 to go by. But some of the facilities have been very slow in getting up and running, and I would single out here the delay in getting the Main Street facility going, where that Main Street support is extremely important. Many businesses are at risk of failing, if they haven't failed already, as a result of delays in providing a safety, in throwing safety lines to them. Now, there's a good reason for these delays, don't get me wrong. That facility is fraught with difficulties, and I'll talk a little bit more about them. But my point isn't that the Fed could have done this more quickly. I would argue that we really needed a special standing facility for this kind of thing, and we probably should have one in the future. A second positive point I'd make about these emergency arrangements is that most of them are broadly consistent, first of all, with the Fed's monetary policy goal. We'll be lucky if the Fed achieves its inflation target right now. In fact, we should be even gladder if we have a little bit of inflation instead of deflation for the short run. because we've had an adverse supply shock, and we would expect, I would expect prices to rise somewhat if monetary policy is doing all it can to sustain aggregate demand or spending. The programs are also broadly consistent with what I'd call the classical last resort lending principles, the sort that we associate mainly with Walter Bagehot, including one of the less acknowledged of those principles, which is the idea that the central bank should lend very widely. And of course, the Fed is certainly doing that. It's doing most of this not to bail out failing firms, though we'll see that some such bailouts are unavoidable, but it's doing it primarily to keep private funding markets operating, to keep them liquid, and to thereby contribute to its macroeconomic goals of maintaining overall spending and avoiding the unnecessary multiplication of bankruptcies and consequent unemployment, bankruptcies that are a result of inadequate liquidity rather than of underlying mismanagement, etc. The new programs are also consistent with the letter, if not the spirit, of Dodd-Frank, requiring that assistance be, quote, for the purpose of providing liquidity to the financial system and not to aid failing financial companies, a failing financial company. As Dodd-Frank requires, the Fed is not making any special loans to individual firms, whether it designates them too big to fail or for any other reason. There are only broad-based programs, and that I think is an improvement. It's not there isn't any bailing out going on in the present program. The CARES Act has allotted to the Treasury $500 billion, about 50 billion of which have gone to its direct support of air carriers. But that's Congress's business. We don't have the Fed engaged in what might be construed as outright bailouts of a particular subset of firms. The rest of the Fed Treasury's contribution to the program, to the Fed's, to emergency lending and support, consists of the backstops provided for the various Fed programs. That's $450 billion worth of backstopping, of which Congress has so far assigned about 200, a little less than 200 billion, and the rest is still up for grabs. Now, these backstops of Fed lending are themselves very controversial. There was some reference to them as a Treasury slush fund, et cetera, et cetera. But I think that from the Fed's point of view, at least, their existence is justified. I think it's an appropriate interpretation of another Dodd-Frank provision that says that the Fed has to protect the taxpayers from losses on any of its 13.3 lending programs, which are the kind we've been talking about. Congress is supposed to wield the power over the purse in this country. And if the Fed were to lose money on any of its lending programs without a Treasury backstop, it would be essentially appropriating for itself monies that would otherwise go to the Treasury through the Fed's remittances of its revenues there. So the Fed has understood or interpreted Dodd-Frank as saying, yes, we can make risky loans, but no, we can't lose money on them. The Treasury has to put money into those programs to the extent that they might incur losses, where, of course, this money has been properly appropriated by Congress. Therefore, we have permission to lose it because Congress has made an appropriation for that to that end. So I think that from a constitutional legal point of view, these Treasury backstops are not just okay. I think they're absolutely essential. Otherwise, the Fed would be in violation of Dodd-Frank, but more importantly, I think it would be in violation of the understanding of where Congress's prerogative ends and the Federal Reserve's prerogative begins regarding the use of taxpayer funds. Okay, now for my concerns, very quickly, because I only have less than 10 minutes. One concern I don't have yet, but a lot of people do, is that all of this is going to result in a heck of a lot of inflation once the crisis is over. Well, that's the same sort of talk we heard back in 2008 and for the period after that when the Fed was engaged in quantitative easing. As everyone now knows, we didn't have a lot of inflation, and I don't think we will have much inflation this time for the same reason we didn't have it then, which is that under the new Fed operating system, the size of the balance sheet isn't linked the way it used to be to the growth of broader money measures and ultimately to spending and inflation. Instead, as David Beckworth has put it, there's been a great divorce between those things. Now, if in order to control inflation, the Fed mainly relies on the interest rate it pays on bank reserves. By raising it enough, it can always make sure that banks hold on to new base money, new reserves that they've got on hand. And that is how the Fed contained inflation during the recovery from the 2008 crisis, and it has the same capacity to do that after this crisis, no matter how big its balance sheet ends up being. So unless the Fed caves in to pressure such as will make it not try to heed its mandate, I don't think inflation is a likely result of what's happening now. It is certainly something we should be concerned about. I'm not saying we shouldn't, but what we need to worry about is not the Fed's technical incapacity to prevent inflation in the future, but its lack of will to do so. So that's what the inflation concern should be. Moral hazard is a big problem because the Fed has extended its safety net now even further than was the case during 2008. And now, of course, the expected consequence of that in the long run is that even firms take even more risk in the future regarding the kinds of assets they hold for their savings. And that is something we have to be concerned about because it means that they'll be all that more vulnerable when the next crisis comes. You might say that firms won't, what firms will put aside for a rainy day depends on how big the Fed's, how big an umbrella the Fed is perceived to be prepared to hold out to them. There is some risk that the Fed's big balance sheet will not unwind easily. We've already seen how the Fed, having promised to unwind its $4 trillion plus balance sheet the last time around, never did get around to it for various reasons. So I'm afraid we're in for some balance sheet hysteresis this time around, where we aren't going to go back to $4 trillion. Perhaps we won't even go back to $6 trillion. A year or two ago, I predicted that Chairman Powell would be the first $6 trillion chairman, and if you're as old as I am, you know the joke. But now it looks like he'll be a more than $6 trillion chairman pretty soon. All of these programs, and here I get to plug my new book a little bit, are set a precedent for what I call fiscal QE. That's the use of the Fed as a vehicle for financing stuff where that financing doesn't have much to do with ending emergencies or dealing with emergencies. The more kinds of assets that the Fed buys, the more kinds of loans it makes, the more it entangles itself in so-called fiscal or credit policy and in allocating funds to different programs, projects, industries, markets. And the problem with that is that people see this and they say, wow, you know, the Fed can support these things. Why can't it support our program? Why can't it pay for walls on the border? Why can't it pay for green investment and so on? My book was meant to be a warning against that sort of thing, and I think we're gonna need to warn against it all the more as a result of these ambitious, so far, emergency Fed support programs. Finally, I think the Main Street program, certain programs involve the Fed in politics a lot more than others, and are more likely to prove problematic for that and other reasons. The one that concerns me the most is the Main Street program. The Fed is very poorly equipped to lend to Main Street, particularly during a depression. Ordinarily, business lending is very, very risky. At a time like this, it's extremely risky. So the chances are that these loans will fail in many, many cases. Indeed, I don't think the program can work well in achieving its goal, which is to keep companies afloat, unless the Fed is prepared to take on a lot of loans that ultimately fail. As we've seen, it's got a Treasury backstop that's about 12.5% of the loans it's allowed to make. I fear very much that it will never lend 600 billion, as is the intention, given that backstop. Even though it seems like a heavy backstop, it's not that good for this kind of lending. Instead, I think that there are two possibilities, both of which will result in a lot less lending than is intended. One is that the Fed is too picky about the loans it makes, and there's a lot of precedent for this in what happened the last time the Fed lent to ordinary businesses during the Depression. In that case, it could end up not approving of very many loans, and this of course depends on how its bank partners behave, but it could end up not approving of many loans, of imposing overly stringent conditions. There's already some evidence that that's happening, and as a result, it doesn't end up making anything like 600 billion in loans, though it also doesn't use all of the capital it's been provided by the Treasury. Alternatively, they could be indiscriminate. That's also a real danger when you consider that the banks are only going to own 5% of the business loans they originate under this program. The Fed's going to own the rest. The Fed doesn't have the staff to do a lot of due diligence. But in that case, what might happen is it eats through the $75 billion Treasury backstop well before it lends 600 billion, and that's that, unless it gets another injection from the Fed, from the Treasury. Now, I personally think that these are all reasons that why the Fed shouldn't be doing this. This should all either be done by a small business administration type program. And indeed, back in the Depression, it was the Reconstruction Finance Corporation that ended up doing most of the business lending, a lot more than the Fed was ever able to do, even though initially the thought was the Fed would do more than the RFC. The RFC had plenty of problems, don't get me wrong, but it did ultimately prove a much more effective vehicle for helping businesses out during that earlier crisis. Another thing about this is that there's a myth that the Treasury and Fed have both encouraged that, well, using the Treasury's money, congressionally authorized funds through the Fed allows us to lever up. So the Fed can lend many times the funds that Congress has supplied as backstop money. Well, that's true, but it doesn't mean that the taxpayers are any better off, because in one case, you have the Fed borrowing from the banks and paying ultimately interest on reserves for the borrowings, and that's what's funding the loans. Or you have the Treasury just issuing more securities to fund the loans. It doesn't save anyone any money right now for the Fed to be doing the funding. It has only the advantage of being off balance sheet and not counting towards the federal debt, but that's purely cosmetic. It would probably be wiser if Congress just bucked up, figured out how much money it wants to give to Main Street, and lend that amount or give that amount, as it were, directly to the firms that need it through a program designed for that purpose, and forget about the Fed and forget about leverage. And this gets me to the last remark I want to make, and then I think I'll be right about on time, is that this program and also the Muni program, this is a program where the Fed buys municipal bonds, they both entangle the Fed so much in politically charged decision making. Which firms survive? Which ones fail? Which governments get funding? Which ones don't? Ironically enough, the reason this Fed has been involved in these programs, it's not, as I just explained, because it saves taxpayers money in the long run or reduces the long run fiscal burden. It's because the Fed's nonpartisan status makes it easier for Congress to fob off responsibility on it for these politically charged programs. But the more it gets involved with such stuff, the more it becomes entangled in politics and controversy, and the harder it is for it to maintain the autonomy it needs to be an effective device for implementing monetary policy. That is, the more its independence is threatened, the more likely that independence is to be undermined. Well, that's it. That's my summary in about 35 minutes of what's been going on at the Fed. And I'm happy to answer questions if we have time about any of the stuff I've reviewed. Thank you.
Thank you. Thank you very much, George. I have several questions to ask you myself, and there are questions flowing in from the people who are watching this talk on YouTube. But if it's okay with you, I was wondering if you could take all the questions together at the end, and perhaps then let me invite Chris to tell us about fiscal policy and its consequences given the state of affairs today. Chris, the floor is yours. Thank you.
All right, thank you, Vipin. I think several of my comments will complement some of the things George said, although I think they'll be different enough that we can have a broader discussion about how fiscal and monetary issues complement each other, but also diverge in several areas as well. And the way I thought I'd proceed is in a series of questions that I want to answer. And what I'm going to do is start very broad. And I don't want to make my comments, or I'm trying not to make my comments US-centric, even though I will draw on some examples from the United States. But I'm hoping to also talk about the role of fiscal policy in pandemics, both across geographic space, but across time too. So not just in the current situation, but what can we expect or hope for from fiscal policy, both historically, but also in the future as well, because certainly pandemics have always been a part of human life and will continue to. And so the questions I want to talk about is, number one, what is fiscal policy? Let's start from the ground up. Why fiscal policy matters in pandemics. What can fiscal policy do? And related, what can it do? And then why does that matter? And then I'll finish up with that. And so what's fiscal policy? Well, in the broadest sense, fiscal policy relates to government spending, and specifically adjustments to government spending, as well as adjustments to the sources of the money or revenues that are utilized for that spending. Now, the question, of course, is toward which end? What is the end of making these adjustments? What is government trying to do? Well, to provide a little context here, in the post-World War II period, the kind of dominant view in economics in matters of fiscal policy falls under the purview of what's called functional finance. So a lot of people talk about Keynesianism, And of course, this stems from the work of John Maynard Keynes, but really much of it has kind of gotten bastardized in a way from what Keynes said by his followers, Keynesians, which is such a broad category of people and what they mean by that and how it's and what they interpret Keynesian policy to be, that it's not easy to summarize. But then you have this idea of functional finance, which is linked with an economist by the name of Abba Lerner. And really and by the way, most people, when they're talking about Keynesianism, when economics textbooks talking about it, really what they're talking about is functional finance. And it's this idea that government should use its fiscal tools, again, spending, to achieve certain social goals. So it's things like prosperity, economic growth, to smooth business cycles and so on. So that's the end. That's the purpose of fiscal policy, or at least the dominant view of how fiscal policy should be achieved. So that's broad context. So now let's move on to my second question. What or why fiscal policy in pandemics? And if you have been following how both policymakers and economists talk about fiscal spending, both in the United States and elsewhere, in the context of the current COVID pandemic, there's a few things you'll see highlighted. And some of these overlap, but they're also kind of distinct categories. So what's the role of fiscal policy? Well, one that you'll see discussed is that government should be utilizing its spending powers to fund health-related research. That can be things like vaccines, other types of innovations in protective gear, and other kind of research in both minimizing the effect of the current pandemic and then preventing future pandemics or responding to them. So that's kind of health-related spending. Second, immediate relief. And George touched upon this in his comments when he was discussing loans to businesses and transfers to individuals, as he put it, to keep them afloat. And so what's the purpose of this immediate relief? Well, the purpose is, look, we have this shock in the form of a pandemic. People obviously are suffering greatly, and they need assistance. They need money to pay their bills, their mortgage, food, to pay employees if you're a business operator, and so on. The idea being that government can utilize its spending powers to assist individuals in short-term immediate relief given this shock. The third kind of broad category you'll see being discussed is economic growth, or to stimulate aggregate demand, you'll hear, which is the standard kind of way that fiscal policy, it is argued, should be used, again, towards the goal of growth and prosperity. And so when there's a fall in aggregate demand, the argument goes, government should kind of fill the gap by stimulating economic activity through spending. So I'm not passing judgment on any of those, by the way. That's just laying out my interpretation of how people view the role of fiscal policy in pandemics. So then this puts an important question on the table, which is, given what fiscal policy is, given the entity, government, which again is a kind of catch-all for all the different levels of government involved in this, of course, and those political institutions will vary from country to country, and then within country at the state level or the more local levels. But the important question is, what can fiscal policy do? What can we hope that it achieves, both under first best scenarios and then second and tertiary and so on, best case scenarios? And here we need to step back for a moment and go back to Econ 101. Which oftentimes is forgotten, but I think it's an important exercise, not simply because it's fun to discuss basic economics, but because it goes a long way in explaining what can and can't be accomplished, which is hopefully what we want to talk about, given the shared goal of improving human welfare. So what can fiscal policy do? What can spending do? What I want to suggest is that what government spending can hope to do is increase certain predetermined outputs. Those outputs predetermined by government planners, by the people that are making decisions about how government spending is allocated. What it can't do is produce value-added outputs that are necessary for economic growth. Now, if you're following me, I'm gonna provide some detail to that distinction I just made. There's a tension here, which is that proponents of fiscal stimulus to achieve economic prosperity and growth seem to suggest that government spending can achieve those things. I'm suggesting it can't. And let me provide some detail to that, some background to the claim I'm making. I want to step back and talk about what is growth. what is economic prosperity? The way many economists and certainly many policymakers talk about it is that growth and prosperity can be measured by some aggregate numerical figure. Certainly, reference to per capita GDP or changes in per capita GDP or GNP or whatever other measure people are using as a shorthand for prosperity and for growth or lack thereof is common. And that those metrics are telling you something, by the way. I'm not saying they tell you nothing. But here's the thing. What those metrics are typically capturing is output over a certain period of time within a certain geographic area and so on. That is not what economic growth and certainly not what prosperity is. It is not producing outputs. What it is producing value-added outputs from the perspective of consumers, from the perspective of ordinary people who must consume the goods and services produced. Now, you might say, okay, well, you're just adding in the word value-added. Well, it's more than simply semantics. That language has a meaning in economics, in a particular meaning. And in order to unpack that, we need to step back for a moment and ask ourselves, what's the economic problem? What is the problem that we need to resolve? Not we, the experts, but we, all the people that populate a society and the world. So what's the problem we need to resolve? Well, really what we need to resolve is, given that we face scarcity constraints, again, this is just Econ 101, we need to determine how to best utilize and continually update the use of scarce resources. The answer to that economic problem is not known and it's not given. That is, there is no single answer that is predetermined and given about how scarce resources should be allocated to maximize some notion of social welfare. We need to discover that. Well, how is that discovered? It is discovered through experimentation. It is discovered through entrepreneurship in a certain institutional context, one where there are prices, market-determined prices, competition, feedback, profit and loss, and so on. Prices provide information about how scarce resources are valued. That is, it's capturing the opportunity cost of scarce resources. And profit and loss capture whether those scarce resources have been utilized and combined in a manner that consumers value, and they provide feedback to economic actors. This is simply a description, a very rudimentary description of how unhampered markets operate. But it's important because it is telling us what is necessary in order to produce value-added output. So why does this matter? Well, it matters because the economic problem, which again is necessary, I would argue, for economic prosperity, growth, and so on, improvements in human well-being, is not an allocation problem. It is not an allocation problem from the standpoint that it is a problem that can be solved by experts, by well-informed, highly intelligent expert planners. Rather, the economic problem is a coordination problem. It is a problem of how do we, given that people have different expectations, different knowledge, different subjective perceptions about the world, meaning what they perceive as value-added uses of scarce resources, how do they coordinate? How do they coordinate and figure out how to interact with one another and to continually reallocate scarce resources to produce things that people value? So why does all this matter? Well, let's again go back to the idea of fiscal policy. And the argument goes, again, government can spend money and increase prosperity. And that's missing all the underlying dynamics and mechanics that go into producing genuine prosperity. And again, this is not an idea that's new to me by any means. It's not an idea that's new to the study of pandemics or the current situation. It's been applied to many historical episodes. One that I'll briefly highlight, and one that I suggest you look at if you want more detail about what I'm talking about, is World War II. The economic historian Robert Higgs has done wonderful work to kind of unpack the orthodox story of economic activity during World War II. And that orthodox story, again, in a very rudimentary form, given time constraints, goes something like this. There was a major economic downturn in the United States, and government spending and production during World War II served as a massive stimulus that led to a massive increase in aggregate demand, and ultimately to economic recovery and prosperity. And what Robert Higgs does in his work on this topic is to unpack those claims. And he says, look, it is true that if you look at things like GNP measures, that they increased during the war effort. If you look at unemployment, it fell during the war effort. If you look at consumer spending, it increased during the war effort. He says, so certainly at first blush, you would say that the war effort caused prosperity and increases in economic growth. And he says, but we need to unpack these things. So let's think about what happened. Well, government shifted resources, scarce resources, into what? Producing tanks and bombs. So of course, GDP is going to go up. But the question then becomes, is the production of tanks and bombs value-added outputs, which improves the well-being of individual ordinary citizens? And Higgs says this is not. It does not, excuse me. That producing tanks and bombs might serve some function, and it certainly increases output, but it does not improve the well-being of ordinary citizens. You look at unemployment numbers, of course, people were pulled into the war-producing effort, including, of course, the conscription of a significant portion of the population. So, of course, unemployment figures are going to fall. And so when Higgs pulls out military-related spending from gross national product, you see that it falls during the war effort. When you pull out military-related employment, unemployment doesn't actually fall. And when he makes adjustments to consumer well-being, makes adjustments for inflation, that is, he finds that the effects of the war-related spending were minimal. Of course, in addition to all the other wartime restrictions that were put in place, rationing, number of hours worked, and so on. I'm going to come back to that later on, which makes this relevant to the current situation. But my broader point is one of keeping in mind this important distinction between simply producing outputs, which certainly would create economic prosperity in the aggregate if you're just simply looking at raw output numbers versus value-added output. So let me return now to my earlier question. What can fiscal spending or fiscal policy do? Well, here's what I want to suggest to reiterate what I was saying earlier. Certainly, it can increase certain predetermined outputs. So certainly government can give a check to individuals. It can give a check to businesses. And those individuals and businesses then can spend that money. And it might very well make them better off compared to the situation they were in prior. That's the best case scenario. I say at best to return to an important point that George touched upon in his closing comments. And that point was one of, we can think about political institutions doing something that generates the desired outcome, but we always need to take account of the political process through which that policymaking gets determined and implemented. And so I say it's at best it can increase outputs, because when you look at the actual political institutions through which fiscal policy, for the purpose of what I'm talking about, monetary policy in terms of what George was talking about, when you take into account the incentives that individuals face in those institutions and outside those institutions in kind of periphery political institutions, oftentimes it generates very perverse outcomes. And so, you think about the situation in the United States. And so, the U.S. government implemented about a $2 trillion fiscal relief package. But if you look at this, there's basically zero oversight on how this money is being spent. There's no inspectors general, there's no congressional panel of oversight. And if you listen to policymakers, they'll say things like, well, this is too important to worry about those things. We'll worry about those things later. We're in a crisis situation, and what we need to do is spend. And you may or may not agree with that. I'm not going to take a position for now on that. But what I will say is this, which hopefully is not controversial. If you are injecting a significant amount of money into the economic system, and there's little to no oversight, I think it is safe to assume that we can predict that there will be a significant amount of waste. Now, again, you might conclude that that waste is okay, that that's just a cost of doing business, if you will. But it is not as simple for one to say, well, look, government needs to help people and they will help people. Because of course, one of the things we need to worry about is that to the extent there is waste and other frictions at work here, the resources that are being allocated to presumably help people who are suffering may never end up in the hands of those people, precisely because of the various dysfunctions and pathologies of political institutions. So it's at least something we need to think about and take seriously. The other thing we want to think about then is the political process that replaces the market process. Of course, when you rely on politics to allocate scarce resources, which is what is required when we're talking about fiscal policy, what happens? Well, instead of the kind of market process I was discussing before, market determined prices, feedback through profit and loss, experimentation and contestation of ideas by entrepreneurs, you get bureaucratic rules that govern how bureaucrats allocate those resources. And that might, again, be all fine and good, and you might endorse that. Again, I'm not here to take a position on that, but rather to point out the reality of it, which again, you still need to allocate scarce resources. You can't escape that. Well, how are you going to do it? Well, if you look at something, for instance, like the Small Business Association. And so, if you look at the $2 trillion fiscal package, which I mentioned a moment ago, the rough breakdown of that first $2 trillion relief package, I say the first because there's discussion of subsequent packages being introduced in the United States by Congress, is a breakdown like this. Individuals or allocations to individuals constitute about 30% or $600 billion. That's cash payments, unemployment benefits, and so on, that are intended to target individuals. Large corporations are receiving about a quarter, 25% of that money, about $500 billion. Small businesses is about $350 billion, which is about slightly under 20% of the total $2 trillion package. State and local governments are getting about 17% or $275 billion, and then about 9% or $180 billion is going to the category that's called public services. But I raise this because if you look at small businesses, for instance, how's that money allocated? It's not allocated through some kind of competitive market system because it's not the market allocating it. It's government, and it's allocated on a first come first served basis. Who applies, who gets approved, they get the money first. And so you say, well, why does this matter? Well, it might matter, for instance, because there's no guarantee that the folks that are most in need are actually receiving the money. If they are not fast enough, they are not nimble enough to get in the queue before the money is exhausted, which of course that program, the $350 billion, has hit its cap, meaning that the money's been accounted for now, meaning those that didn't get it, who are in the queue, have to wait to see if more money will be allocated towards that program in subsequent rounds of relief. They can't receive money through the program. And you can find these various stories of corporations, very large corporations, receiving the money. You say, oh, wait a second, I thought you said when you were giving the breakdown that there's a bucket for large corporations and a separate for small businesses. And there is. But the way that these things are categorized, if I'm remembering correctly, is small businesses are defined by the number of employees. And depending on the industry, the cap is either 500 or 1,000, depending on the industry you are. And so let's say you're a large corporation, but you have restaurants. That local restaurant, as long as it employs 500 people or less, can apply for money through that program. They are in a privileged position because, of course, those larger corporations, larger businesses tend to have resources, an entire legal department that is quickly able to operate and get them in the queue to receive funds. Whereas smaller businesses who may not be as nimble don't have recourse to those resources that allow them to be nimble. Again, I'm not passing judgment on that. That's just the way it is, but it's something you might think about in terms of the allocation of those resources. And so let's think about what the implications are about not being able to create economic growth. First of all, we shouldn't talk about that. Economists and policymakers, if you follow and buy into the way I'm discussing and thinking about these issues, shouldn't talk about fiscal stimulus creating economic growth. It doesn't mean there's not a role for it. You might say that, look, people are suffering and they need assistance, and I believe government is the only way to do that, given the scale of the issue, given the state of the world, that there's a government apparatus that exists, and so on. And again, presumably or in principle, it can do those things. It can assist people, assuming the political institutions are such that the resources are actually transferred to those in need. Now, here's the thing. Even if the resources can assist people, at best it's a Band-Aid. It can help people, but it doesn't address the root cause. What is the root cause? Well, we know what the root cause is. The root cause is that there has been government intervention into the marketplace, into the market, that is preventing people from engaging in economic activity that actually produces value-added outputs and genuine prosperity. Now, why is there that intervention into the marketplace? Well, because of a pandemic. So again, you might say that it is necessary to have that intervention. That is what, and again, this varies from country to country, and then even within countries, within locales, the type of interventions into economic activities vary greatly. But in short, and kind of in the extreme, government says you being citizens in a certain geographic area, you are not allowed to do X, Y, and Z because we are determining that it is non-essential and only essential economic activity can take place. Well, of course, that's going to lead to hardship. You have violent intervention into the marketplace, again, in the name of protecting people from presumably some greater threat to their well-being. Again, I'm not taking a position on that, but that's the logic. But that, of course, is going to put a halt to a significant portion of economic activity and create hardship. So the only way to address the root cause is to remove the government restrictions on economic activity. Now, there is great debate, and much of this falls outside the realm of economics. And so, again, I have no position on this proper. I don't pretend. A lot of people do, especially on social media, to have insider knowledge on epidemiology and related fields. I certainly don't. But there's great debate, as I'm sure many of you are familiar with the right way to remove government blockages to economic activity. Again, with the goal of minimizing the health-related threats caused by COVID. And so I have no specific plan or prediction. I don't think anyone does on how to do that. Certainly not in a global or even national sense. I think it's a very localized issue. But until you do that, until there is removal of those blockages, there's not going to be a return to economic, value-added economic activity, growth, and prosperity. And this is important. You know, a lot of times these discussions kind of people say, well, a lot of the things you're talking about with this theoretical underpinnings of value-added output versus output, those things are very esoteric, and that's things you learn in the classroom. But I want to suggest they're really important for human well-being. And so, oftentimes people say, well, okay, these are economic costs. You're just worried about profit loss. We're worried about human beings and human life. But one of the things I think is important to emphasize is, economic costs are ultimately human costs. That is that when you preclude people from engaging in value-added economic activity, that has a real effect on human well-being. An article on Reuters a day or two ago, the headline read, "The United Nations warns economic downturn could kill hundreds of thousands of children in 2020. So why, if you read the article, is this prediction being made? Well, of course, some of it is due to the pandemic itself, but more broadly, and what the article goes out to point out, is that it's due to the unintended consequences of policies that are put in place to deal with the pandemic. By blocking economic activity, you are causing a downturn in economic well-being, which falls upon the most marginalized people globally, as well as within geographic locales. And so that's certainly something we want to think about and talk about. And again, it's not always clear-cut what that balance is between dealing with the pandemic and the threats related to that and economic activity, but certainly something that can't be dismissed. And that's very important, that fiscal policy cannot resolve. You cannot overcome the fundamental root cause of what is causing the economic hardship without removing the blockages that are preventing people from interacting. I have about, if I'm thinking about this right, about 5 minutes left. And so I'm going to finish by addressing or putting on the table three other issues. that I want to mention, especially given the audience here. And then we can open up for general discussion. The first relates to something George said. He put it in terms of unwinding the balance sheet. I think that's an important point. I want to put it in terms of deficit spending and the long-term economic implications, which again are highly contested among economists. When I say it, I'm talking about the long-term economic implications of deficit spending. And I don't want to take a specific position on that point, but I do want to point out that it's something to think about. And one of the powerful things that economics can help us think through is the incentives people face. Again, in George's context, unwinding the balance sheet, and in my context, deficit spending. There's an important book that was written by James Buchanan and my colleague, Richard Wagner, published in 1977 called Democracy and Deficit. And they critique Keynesian, or what became Keynesian economics. And it could equally apply to what I was talking about earlier in terms of functional finance. And the way this worked or the way it was envisioned by proponents is something like this. During times of aplenty, during good times, a government should save money. It should bank money and put it away in kind of the equivalent of a rainy day fund. And then when times are not so good, when there's downturns, it can spend down at least part, if not all, of that rainy day fund in order to overcome the various ills. And then when the good times return due to well-timed and well-placed government spending, it can save again. Of course, that doesn't happen. The reason it tends not to happen is because of the incentives that politicians face, which is that if you are a politician, you want to spend money. You don't have an incentive to save so that other politicians in the future can spend that money. And so again, that's something we want to think about. What else do we want to think about? Well, civil liberties, that's another thing we want to think about. And you say, well, how does that relate to economics? Well, think about what I was talking about earlier in terms of the trade-offs with health and economic costs. Well, as government in America and elsewhere starts to ease restrictions on economic activity, the question is, what do you do? How do you deal with the fact that there's still going to be a virus? And there's lots of different proposals. And again, I have no grand blueprint for any of this, and I don't pretend to. But one of the things we need to think about is data and information collection. And so different countries are dealing with this differently. But there's discussions of, in order to pull this off, you're going to have to collect a lot of data and information on people, health data, personal information about their, everything from their temperature to the people they've interacted with. There's these discussions of these apps that have been developed and will be developed, that would say, okay, Chris has Chris got sick. Who has he interacted with? Well, George Selgin and Vipin. So now we can trace him through his cell phone and then, track what they're doing and inform them. And we need to think about this. The reason this all relates, of course, goes back to Robert Higgs again. In different work, he's talked about the size of government. He calls it big government, capital B, capital G. There's the scale size, which is the fiscal and monetary aspects, the kind of things that economists normally talk about, but there's the scope or range of government activities as well. And as Higgs points out, once government takes on new powers, it rarely gives them up. It's not that it never gives them up, but it never declines back to its previous level. And so that's something else we want to think about. And finally, the other thing I just want to put on the table for discussion, and I'll just mention it, is the crowding out effect of government, fiscal, and monetary policy, I would put it as well. And crowding out here is different than the way economists often talk about it, even though I think it does matter in normal economic activity terms as well. But for the purposes of the audience here, I think it's important to discuss about the crowding out effect on civil society. And what I mean by that is that as people become dependingly and increasingly dependent on government as the solution to pandemics and other crises, it crowds out civil society. It crowds out private people figuring out solutions to these problems in order to address collective action problems in effective ways, which are often very localized and require context-specific knowledge and information. And so that's certainly something else I hope that you'll all think about and perhaps we can discuss further. Thank you very much for the opportunity to talk with you today. I appreciate it.
Thank you, Chris. Let me, Yazid, would you mind having us all on a screen now, and then we can begin with.
All on screen right now.
Perfect, great. So I'm going to begin with there's a bunch of questions coming from people who've been listening in on YouTube, but I'm going to sort of take advantage of my position as the moderator and begin with some questions of my own. Um, uh, my first question is to George. So George, as I was listening to you, I sort of began pondering over um, how a system without central banks would deal with this, would respond to this crisis from a monetary point of view. And then I started sort of trying to see how close some of the central bank responses have been to what a private banking system would do. So in some senses, how close is the central banking system to mimicking what a private banking system would do? Is when I think of this sort of the shock that the system has received, not only from COVID, but more so from the government lockdowns, there's a fair bit of reorganization of the economy that is going to happen. Some of it because of the short-run government lockdown, but some of it because of the longer-run consequence of COVID. For instance, I can imagine some companies not wanting to source important supplies internationally, because they don't want to risk, their important supplies being cut out. Suppose if you're an automobile manufacturer, you probably don't want to source brakes from China anymore. I'm just, some companies may not even want to source supplies from other states, let alone other countries. I can even imagine the number of companies declining. So in the United States right now, there are 6 million firms with employees. I can imagine a lot more vertical integration, where companies don't want to really buy from other companies, but want to sort of produce things in-house. So the make or buy decision changes. Those are just a few things. And then, of course, there's probably going to be an expansion of the companies which provide services like Zoom or Amazon, for instance, which, stock prices have done reasonably well. And there's going to be contraction of certain other companies which work in the area where there's face-to-face contact. So there's a lot of reorganization of the economy that is to happen. And, I was wondering how much of that reorganization is getting helped by the monetary interventions that the Fed has done, and how much of that reorganization is getting hurt by the relative price deviations that that the Fed might introduce. Because I can imagine that in a private system, people, there is a liquidity crunch, right? So, I mean, suppose we had a completely free banking system without the Federal Reserve, I can imagine people start issuing IOUs to each other, right? Because if I can't pay because I just don't have the cash flows, I can think about, those people I have to pay to, saying, I'll take IOUs for now. I can also imagine that the IOUs is actually money issued by some private bank, where the private supply of money kind of grows. But in that kind of a setting, that expansion of money supply would correspond, or would take into account the risks or the distribution of risks in the economy, and would sort of tailor to the readjustment of the economy that is to happen. Whereas now, with the at least with the Main Street lending that you mentioned, it seems that the Fed is bypassing the financial and the banking sector. So we are actually bypassing risk assessment and the assessment of where not only money but real resources are to flow, to make sure that the economy goes through the readjustments that we have to sort of get it to go through. So, so that's sort of my concern here. What do you think, George?
Well, I doubt I can give you as long an answer, as detailed an answer as you've given me in your question, but I will try to say something succinct. Look, this is not a question of the government improving on market allocations. We all can agree on that. This is a welfare problem. This is a redistribution problem. This is a crisis where if we don't, and I'm going to take for granted the interventions that are keeping us all home. Unlike Chris, I don't see them as the root cause. I think the root cause is a disease, and the interventions that are keeping us home are perhaps a bad response to that disease. But I'm going to take that response as given. No free market is going to solve the problem created by the fact that most of us aren't working right now. no free market solution is going to keep businesses open for which there's no, that are not selling anything to anybody. This is a welfare program. This is a gigantic welfare program. It's true that the Fed is also engaged in liquidity creation to limit some of the spillover effects. But the bottom line is a free banking system cannot do what the government's doing now, if that's what you want, which is to keep a lot of businesses operating that would fail otherwise. But let's not kid ourselves. The alternative, again, given that we're all staying home, the alternative to the various programs we've been talking about is that all these businesses go under and we have a tremendous crop of bankruptcies. And that's also very, very wasteful. So what you have here, to go to Chris's central banking, central planning point, you have a choice between two options. One is a government intervention and central plan that tries to limit the extent to which the world changes when we come out of this, that tries to keep some considerable share of the enterprises that we had going into this crisis running so that they exist when we come out. The alternative, which would be all of the alternative, I'm sure, with a free banking system, given its inclination not to lend to people who can't afford to repay loans. The alternative, with government involvement, I should say, without government involvement, is that we have all these firms fail and we start from scratch. That's an incredible undertaking. I don't think it's optimal, for whatever your opinion of closing down businesses and having people stay home is. I don't think it's necessarily a good idea to just let the chips fall. I don't know what the best outcome is, but I'm pretty sure that's a very, very wasteful outcome. So what we're doing here is we're comparing the waste that's bound to come from these interventions, the waste from arbitrary small business administration loans, the waste from risky Fed lending, the waste from arbitrary municipal bond purchases, the waste from the airline loans, etc. We're comparing that massive waste with the massive waste that will come from just letting businesses go bankrupt. I don't know which of those. I don't dare to step out on a limb and say that the waste from the bankruptcies is going to be far greater, but I wouldn't rule it out. And free banking won't do anything about that, because this is welfare. This is welfare. This is extending loans and other fiscal grants to institutions that probably would not get funded or wouldn't dare to borrow in a entirely market context. So once you have everybody not going out and buying stuff, you're in Chris's world of the tertiary, or maybe some higher level of order of non-first best. And that makes these calculations difficult. By the way, I agree with everything Chris said about letting markets do their thing, and the closing up, the lockdowns being harmful. But it's all very easy and clear if you make the virus a kind of a minor player, just as it's easy and clear that we shouldn't have had World War II if you ignore Hitler, right? So I'm not taking a position on this, as Chris likes to say. I am saying, though, that this is not a simple matter where we could have just have let the market do its thing and everybody would be happy and everything would be efficient. Once we accept the fact that the virus confronts us with a tragic choice between staying home or perhaps getting ill.
Right. I mean, I would love to sort of, ask you, talk to you more about this, but since we are sort of short on time, let me ask Chris a question. So Chris, typically when people think about fiscal policy, and this is one of the reasons why I reached out to you and not to a macro, standard macro economist. Typically, people think about fiscal policy. They think about adding numbers. It's sort of an accounting kind of a thinking. C plus I plus G. That the GDP is going down, and we're going to add numbers somewhere, and that's going to push up the whole GDP story. One of the things that we've seen at the ground level in India, and I don't know, perhaps it's very different in the United States or Western Europe, but at least in the ground level in India, is there was a perception, or there has been, and there still continues to be a perception that markets are not really for the poor, right? That markets typically cater to the rich. But as soon as markets got shut down with the nationwide lockdown that we've had in India, the poorest of the poor have suffered the most in terms of gaining and trying to gather the essential resources like food, water, just trying to eat 2 times a day. So what was essentially happening was the poor were feeding each other through market transaction, for-profit transaction. All of that has been shut down. One of the things that the government has tried to do, and different governments, not just the federal government, but different sort of state governments and things like this, is try to step in and make up for the market. And they have done things. It's not that they haven't, but we've also had stories, and this continues to flow in, where poor people line up from 6 in the morning at 40 degrees centigrade heat or 45 degrees centigrade heat just to get lunch, and very little lunch. So it seems that the government has not been able to fill in for the role of the market in providing basic commodities for the poor. So fiscal policy at the ground level seems to be very different from the usual Keynesian kind of C plus I plus G story. We've had also cases of police excesses, if not outright police brutality, where food would be given to poor people if they line up at a certain location, but they're locked down, so they can't go to that location. So you have people walking 5 kilometers or 10 kilometers, and they get beaten by the police on the way, saying, "Why are you out? You shouldn't be out at all." And so, of course, there's a question of state capacity, and here state capacity is far less than in the United States or Western Europe, I would presume that. But fiscal policy at the ground level for common people seems to be very different from what it seems to economists sitting in government bureaus.
Yes, certainly. I mean, one of the kind of paradoxes, not a dilemma that you face with all these type of situations is that in some sense, the elite, the experts have knowledge of certain things, and important knowledge, by the way, I'm not dismissing that, but they have lack of knowledge in many other areas, including practical life. And so in some sense, George, myself, we are among the most insulated from the consequences of the virus because we are privileged enough to have positions where we can stay home. And I agree with George, by the way, I agree with everything George said, both in his talk and response. So given that government lockdown, the trade-off he presents is a legitimate one and a correct one. And certainly the idea of just letting things collapse is highly troubling given that. But here's what I slightly differ, I think. I don't view, and I wrote down George's language here to use it, I don't agree the trade-off is staying home or getting ill, because I don't view it as homogenous and black and white, like 0-1 like that. It is, the pandemic is devastating to some people health-wise, but it can be devastating economic-wise as well. Other people, depending on your age, your health, where you are geographically, can go out, can operate with very little to no effects from the pandemic, from what we know. At least from what I've read. Again, I'm not an expert in this area. Meaning that when you have a kind of a blunt, one size fits all, we must stay home, that has real consequences. And it neglects the trade-off that different people face, which is the trade-off between getting ill and staying home. Even if we take that as the two choices, which again, I think is too simplistic, but even if we do, the costs and benefits, for instance, that George and I face are quite different from some of the type of people that you're raising. And of course, one of the powerful things of economics is what? We can help identify what causes shortages and unintended consequences. And so Vipin, you raised some great examples of massive shortages of basic goods, of unintended consequences, people walking long distances and so on. Even here in America, you know, you get these long lines of people. You'll see these pictures of people waiting in line to get in a store. And they're supposed to be social distancing, but they're on top of each other. Now, again, what's the response to this? I'm not proposing some kind of panacea, but I think that when you impose something like a lockdown or a stay-at-home order, it neglects the diversity of life and discovery, not just in markets, by the way, and this is why I raise civil society, but in civil society. You know, you see these stories of people getting arrested for trying to deliver food or toilet paper to older people down the street who can't leave their house because they're leaving, right? The people who are delivering the goods when they're not supposed to be leaving. Why? Why can't we let people figure things out? Not that everything would be glorious, but I'm saying there's space for that, perhaps in addition to government policy, by the way. So I'm not saying that's an either or. And that's why I'm saying I don't disagree with the things George is saying. And so that's what I'm trying to emphasize here, is the heterogeneity and of many of these issues, and the fact that there is a localized aspect to many of these issues, which I think oftentimes gets lost in these discussions. And I'm hoping to emphasize not as the only issue or even the most important issue, but certainly a important issue.
Thanks, Chris. I mean, we don't have very good numbers on this, and I'm not entirely sure we'll ever have very good numbers on this. The ILO, for instance, had this recent report that several million people are going to get pushed into poverty. The media reports, those seem to be sort of out of crude extrapolations. The media report here are sort of very disturbing. You know, there are women, women who've just had children, infants, who they can't feed their infants anymore because they themselves have not been fed for 2 days. Their husbands can't leave home; they get beaten by the police, and the state has just not been, despite all the promises, has just not been able to deliver food. So, so indeed, for some people like her, it was just well worth. And she's young. She's young. Her husband is young. Infants don't seem to be doing too badly with the disease. Perhaps they could have protected their infants in other ways. For them, it was worthwhile taking the risk to be out, and so the heterogeneity, their voices seem to have been lost. You know, they seem, in terms of the policy making process, they seem not to have played a very important role. But let me actually, we're really sort of close on time. Let me ask one, there's a question, George, for you from some of the people who've been watching your talk on YouTube, which is, you know, how does, actually both for George and Chris, is how does monetary and fiscal policy, how can monetary and fiscal policy help the informal sector? So in India, and perhaps this is less true of the United States, in India, there's a large sector of the economy which doesn't borrow from formal financial markets. They do sort of borrowing and lending from informal markets, which are kind of indirectly linked to the formal markets. So monetary policy does percolate down, but slowly. And sometimes the transmission mechanism is way too weak. So how can monetary policy kind of play a role in helping out the informal sector? And to Chris, of course, the person wants to know how can fiscal policy help the people in the informal sector? Because again, with the government buying of shares or other kinds of direct intervention, it's mostly going to listed tax-paying companies, not sort of lots of small firms in India which may not be listed or even tax-paying for that.
Well, you mentioned trickle down, and in a sense, of course, all credit trickles down from the monetary authority in a fiat system, because they've got the control of the ultimate source of liquidity. But that doesn't mean that the trickling stops at the formal financial system, where the formal financial system ends. And certainly it doesn't stop where the banking system ends. There are all kinds of sources of credit beyond the banking system. Now, increasingly, you have fintechs involved, but also you have all kinds of lenders. You have pawn shops. So we have informal credit systems. They're there, and their access to liquidity, in turn, ultimately depends on what the formal system has. So it isn't as if the informal sector has no access to funds, but by definition, if you're in the informal sector, if you're unbanked, you're not going to get credit from the formal sector. We can talk about banking the unbanked, of course, and we can talk, even as people are increasingly inclined to do, about having central banks provide facilities, provide accounts directly to people who don't have ordinary bank accounts. I personally don't like that idea at all, for all kinds of reasons. I suspect Chris doesn't like it much either. And but the point is that there are market facilities that cater to people who don't have bank accounts. At some point, though, being in the informal sector coincides with being in a situation where nobody's going to lend to you for nothing. You know, if you can't go to a pawn shop and give them give them your overcoat for money, you probably aren't going to get money from anybody else either. But that is how the market right now provides credit for people who have very, very limited means. And I dare say that in a free society, there will always be some people who are not going to be able to have ordinary accounts. We can subsidize them. We can give them accounts or mobile phones, etc. With subsidies, you can do anything, of course. Whether that's worth it or not is a different question. But fintech is going to broaden the extent to which such people have access to funds. That is, it's going to make it possible for people of fewer and fewer means to have more and more access to credit of different kinds. That's already happening. I don't think the government can improve on that very much, except by getting out of the way.
George, do you think helicopter money makes sense in any form? I mean, given the fact that there's going to be all these relative price distortions anyways, and the informal people can't be reached, for a variety of reasons you pointed out, because of weakness in monetary transmission. You think that's an idea worth playing with at this point?
Helicopter money, by and large, and especially under the current frameworks of many central banks, including ours, is really just it is really nothing but a way of having happen off balance sheet what the governments could do equally well and perhaps even more effectively by just sending people checks financed by Treasury borrowing. So what the misunderstanding here consists of the belief that somehow if central banks write the checks and finance them, finance the payments off their balance sheets, that this somehow means that it's all free, that it's cheaper than having the government deficit spend for the same purpose. And that's where the argument for helicopter money becomes very dubious. Now, there are some special theoretical conditions in which central bank financing, monetization of this kind of spending can save money. You have to assume that there will be no tightening of credit in the future, no increase in interest on reserves. There are a bunch of conditions required, all of which are very, very unlikely to hold in practice. So right now, if the US government wants to give out a lot of money to people, just give it away. In my opinion, it makes much more sense for the government to do that directly without the central bank becoming involved than to have the Fed become involved in it. And this also, part of the reason for that is because at some point, a balance sheet loaded down with a Fed that gives stuff away does become insolvent, and it poses problems politically, not technically, politically, for a central bank to operate with negative capital. So I don't like helicopter money right now, and I think it's very hard to come up with circumstances where it makes any sense at all compared to the fiscal alternative.
Chris, do you want to tell us a little bit about how fiscal policy in the informal sector, because at least in this country, sort of the unregistered firms play a very important role in both producing goods and services from the value-added point of view, and also in employing people. They tend to be a lot more labor-intensive than the formal organized sector.
Yeah, I'm not sure I have much to add beyond what George said, because I think he hit all the key topics, which is the defining feature of a informal sector firm or individual, if they're operating in that sector, is that they're outside the formal sector, which means they're typically outside the formal channels of credit markets, of access to various government provided funds through programs, and so on. And so from that standpoint, government provided fiscal monies that flow through various agencies and government programs are simply not going to be available to those folks directly. That they're going to have to presumably seek alternatives. Now, one thing I'll mention, and I know we're up against the time here, but I think another area where we haven't really touched upon, and again, we've been talking about, much of what we've been talking about is within, here's what's happened, so how do you respond to that? But another thing that's interesting is, low-hanging fruit with a lot of this is looking to remove regulations and barriers which preclude people from engaging in value-added economic activity. And certainly in America, you're seeing this. I'm not so sure about other countries, but you see the removal of these regulations, which you very quickly realize are not there to improve human welfare in some large sense, but to simply line the pockets and feather the nests of the politically well-connected. These are things like, well, you only can, use trucks to, either send alcohol or food here, or now we have in some states the reduction of barriers that are allowing medical professionals who are licensed out of state to come into the state, and so on down the line. And so trying to remove barriers to people, whether in the formal or informal sector, is certainly one way to assist people generally.
Chris, what you just said is something that I've been thinking about a little bit, which is I've been wondering if we massively underestimate the cost of regulation. Because typically when we do regulatory analysis, we're thinking about a static environment. Here it seems that what regulation, the big cost of regulation seems to be that it stops dynamic market responses when the environment changes. So the virus comes, right? And now, Tyler yesterday told us that in Taiwan, for instance, a private company was involved in sort of predicting the virus and preparing in advance. It seems that whether the FDA regulations in the US, or we have something equivalent called the Indian Council of Medical Research here. Those are just two examples, of course, but it seems that the big cost of regulation is that it prevents dynamic responses to changing environments. Whereas typically when we do regulatory analysis, at least before COVID, and lots of what I've seen is more static, sort of dead weight loss kind of a thing. So, do you think that's kind of sort of points to new directions in regulatory studies research in some senses?
Well, certainly, I don't know if it's the biggest cost, but it's certainly a cost. Really, the cost you're pointing out, which isn't new to any of us, is unintended consequences and the counterfactual. So what would have, when you talk about a regulation, there's the seen, and then there's the unseen, all the things that would have happened otherwise, which of course we don't know. And what you're pointing out about dynamic responses is one. The other aspect is a very Tocquevillian point about civil society, which is that civil society is not something that is created from up on high. It's not, contrary to like how the World Bank or IMF views it, it's not like funding organizations. That's not what civil society is, at least not in the Tocquevillian or Vincent Ostrom type sense. It is individuals figuring out and continually figuring out, to link it to your point about innovation, how to solve collective action problems. That doesn't mean they can solve them all, by the way. Again, it's not a panacea, but it's an important point. And so one of the things with regulations is it prevents people from flexing their entrepreneurial muscles. And part of flexing muscles is flexing them at a point in time, but also developing them over time. And so this idea of permissionless innovation, that I can innovate both in actual goods and services, but also in ways of civil society, is something we need to think about. And oftentimes regulations preclude those things, and they're not captured in standard cost-benefit analysis because it's an unseen cost. And so that's certainly something, as you point out, that I think is important.
We have perhaps a last question. Again, this is both for Chris and George. One of the listeners wants to know, what would be the effect of US monetary and fiscal policy on the global economy? Are there particular countries that are likely to be affected by the sort of expansionary monetary policy? Are there particular countries likely to be affected by the expansionary fiscal policy? One of the motivations for the question is the fact that the US economy is one of the largest and most connected economies in the world system.
Well, I think that it's very difficult to say what the consequence. Am I on? Okay.
Yeah, yeah.
I think it's very difficult because, of course, we know that what's going on in the United States is harming other countries, but it's not so much the monetary and fiscal reaction, but the actual decline in trade that's a part of the consequences of the lockdowns and production. The monetary and fiscal policies are, have all kinds of indirect effects. Some of them work through exchange rates and that sort of thing, but it all depends on what the other countries are up to as well. I think one of the more obvious concerns for the future has to do with the fact that, as Chris was mentioning, all this indebtedness does raise issues about the riskiness of federal debt, or the risk of default on the federal debt, which in the past was trivial, but is no longer considered so. And I think that in the long run, that could affect the dollar's role as an international reserve medium. But this is a very, very difficult. This is a very difficult thing to predict, because so much can happen between now and the future when the piper has to be paid on these debts, and it all depends on what other countries are doing that offer prospective alternative reserve currencies. A joker in the pack, so to speak, and maybe there are others like it, is Libra. There are of course a number of possible contenders out there for the role of international currency. They're not government central bank currencies, but private alternatives. Right. So I think this crisis will test the dollar's integrity in the long run, or certainly may do so. And I think that's probably one of the more straightforward possible consequences one can trace out for the future, for the global implications of US policy.
You see virtual currency becoming more important, Bitcoin and the likes?
I see virtual currencies as a class becoming more important. I don't know about specific ones, but I don't think this crisis in the long run is going to make virtual currencies generally less popular. I suspect it'll have the opposite effect. But we have seen, of course, that virtual currencies are not immune to a crisis like this. Any claims to that effect, I think, have gone by the wayside, and quite rightly so.
Chris, U.S. government responses and its implications for other nations, other economies, given how connected the U.S. economy is in terms of imports and exports.
Certainly. Again, I don't have too much to add beyond what George said. It's uncertain. Much of the fiscal targeting is domestic. To separate it from the monetary policy, which I realize is silly to do in practice, but conceptually, that doesn't mean it won't affect imports and exports. I think the bigger issue will be perhaps policies related to trade and international relations in the future. And that's unclear. And that's everything from travel to trade internationally and so on. And who knows how that will shake out over the next months and year or years, plural, depending on how things unfold. But certainly that will have effects for better or for worse as well.
Okay, we could, of course, I would love to go on talking, but the organizers say that we are out of time. Please allow me to thank George and Chris for joining us today. Thank you so much for giving us your valuable time. I've learned much from the conversation. Also allow me to thank the listeners. These videos, of course, would be available on YouTube so that they can be sort of watched and learned from in the future. I'd like to close by thanking Yazad from the Center for Civil Society and Akash, amongst others, from the Students for Liberty South Asia, who've put together this conference as a very short notice. So thank you, everyone, and I hope you stay safe and healthy.
Thank you, Vipin. Thanks, everybody.
Thanks. Good seeing you, George. Good seeing you,
Thank
Vipin.
you, Chris. Bye-bye.